Hi, Charlie McNamara with Paragon-Wealth Management. Today what I wanted to talk about is focusing on the long term. With all the volatility, all the news out there, tariffs, everything that's going on, sometimes we have to take a breath, think about what our investments are doing for the long term. So today I want to go through some different statistics. When I go through them, it helps me look out into the future and makes things seem a little bit more promising and easier to swallow in times of volatility. So let's jump into it. The first thing we have up is the Dow Jones Industrial Average from 1900 all the way up to 2025. And if you were a long-term investor, you would have made 10.1%. So again, let's keep that perspective. Look at the chart, look at the different dips during the Great Depression, 2008. We see that the market comes down in times of recessions, or in this case, depression. But a lot of them are blips along the way when you pan out and look at it for the long term. Next, stocks tend to rise or do rise over the long term. So if you look at the probability from 1950 to 2004, we have some rolling periods here. So if you use every 1 year, you have a 74% chance the market's up. 3-year 85, as you can see, 5-year 84, then you go 10-year 92, and 15-year 100%. So again, those are the rolling probabilities from 1950 to 2024. This one is very, very important. Actually, this is probably my favorite slide. A lot of people don't realize this. People tend to think they can jump in and out of the market and man, they're going to get the best buy-in time. They know exactly when to time it. And unfortunately, it doesn't work that way. Let's, in this chart, use the S&P 500 from 1990 to 2024. Fully invested, the S&P averaged 9.8%. You missed just the one best day. That comes down to 6.1%. Two best days, 3.0%. And then, as you can see, from the 3 best days all the way to the 20 best days, you start getting into positive 0.4 on 3 best days, and then all into the negatives. So that's amazing. That's just the best days in the market, not years. The effects of panic attacks on the average investor. A lot of times, unfortunately, the average investor does not make the right moves. You can see U.S. stocks, again, 2004 to 23, 9.7%. You got real estate, 7.6, international equity, 6.2, and homes, 3.7. Then we get down to the average investor, 3.4%. And that is only a few ticks above, or almost 1% above the inflation rate. So keep in mind, panicking usually does not help. I want to get into some of the really big down years and kind of note that even though they feel like they happen all the time, they're very much rare. So if you look, downside of 25% or more, you have 1974, 2008, anywhere from 15 to 25% down. You got 02, 2002, 1973, and then you get to 5 to 15. You do have some of them, but you know, it's not a ton. But then go all the way to the right and look at the up more than 25%. A lot of years up more than 25%, or even 5 to 15%. The most years are up 5 to 15%. So keep all this in mind. Stock market pullbacks are very common. A 5 to 10% pullback happens on average about 3 per year. So an average of about 3 pullbacks per year of 5 to 10%. All right, that's just a pullback in the overall stock price, the pricing of the S&P 500. 3 times per year. That is more than you would think. Even corrections can be normal. If you look here, 10 to 20% correction on average every year, about 1 per year. So a lot of times you think you went through the whole year and you made some money, but you don't remember that correction at one point of 10 to 20%. So 1 per year. And the other thing I'll close with, if you're going to invest, you take with that volatility. You're not going to get the reward if you don't take a little bit of risk. A little bit of risk gives a little bit of reward. A lot of risk can give a lot of reward. So keep that in mind. Volatility is normal. And again, on average, stocks are up 19% a year. And pullbacks, a lot of these pullbacks are, again, 5, 10, 15%. I want you guys to go through these statistics and think about it. Think about where we are now, but more importantly, think about where you want to be in the future and how these may even be buying opportunities if you can stand the volatility. Thanks for tuning in. If you guys have any questions, reach out to us. And I hope you have a great one.